Perfect.
We are recording now.
All right, so we'll start by just giving a bit of background. So my investing history starts out when my mom met my stepdad, and he's been a real estate investor since the time he was in college, and well, actually, technically high school. So I almost said high school, and that's true. He's been a real estate investor since high school, and so I grew up kind of planting trees and working on some of our different units that we owned, and when I was like 16 years old, I was snow plowing our self-storage units. And so real estate investing's always been pretty normal for me and in my family. And I always expected that I would do it at some point. I never expected it to happen in college, but what ended up happening is my stepdad, who got tired of telling me that I should do this on my own. I was in college, and he decided to purchase a piece of property and give it to me. What's interesting is his CPA made me pay for it. His CPA said, you can't just give your son that piece of property, or else you're going to have to pay all his taxes. So he's got to pay something. So it's when I first invested my own money into a property, and I thought it was pretty cool. I owned a piece of America and a little piece of my own land. It was just a cabin lot number 33, Aspen Hills. So it's in Utah, actually. My first piece of property, Fairview County, Utah. And I ended up selling it for a good profit, 12,000% return. By the way, is my internet stable? Is my internet stable?
I've got you loud and clear, and I got clear pictures too.
Okay.
So
Yes.
Okay, good. Just wanted to make sure, because I could go inside or whatever. But so I ended up selling that piece of land, not even because I listed it, but because there was a broker who found out all of the people that owned it as they were putting, it was just a cabin lot, and they were putting electric and plumbing and cable into the Aspen Hills. And so before the value truly went way up, this person had a broker just hand dial each of the owners, and I was one of them, and they offered me something that worked really well for me. It was more money than I had ever seen in a year, and I didn't do anything for it. And so what I ended up doing from that is finally reading the book Rich Dad Poor Dad. And what most people don't know is when they read Rich Dad Poor Dad, they think that Robert Kiyosaki is mostly focused on single family houses, and that's how you real estate invest. But what I learned when I read it and started studying Robert Kiyosaki is he didn't make his wealth in single family. He skipped it. He went to multifamily. So it was 2007, and I remember thinking, I've got to do multifamily. So I thought, what's my path to getting there? And my path to getting to multifamily was, first, I needed to learn how to manage property. Back then, there wasn't, all of these coaching programs. Back then, Rod Cleef didn't exist. Brad Sumrock didn't exist. Dave Lindahl was not teaching this stuff, or at least I didn't know. Dave Lindahl, I think, is the longest period of time, but I never heard of any of that. I didn't know that you could just learn how to invest in apartments. And so I did it the hard way. I went and became a property manager, and I was managing a few different properties, and one of them was an 18-plex, and I was living in the 18-plex rent-free, and I started just managing it and lowering expenses, raising rents, until we ended up selling that. And I didn't own it, but I was the property manager, and the owner ended up making over $1 million in just that 1 year that I managed it. And I remember thinking how powerful that is. I mean, it was just an 18-plex. I'm not talking about a 500 unit building. It was a small 18-unit building, and when we sold, I mean, he had a really good year, a better year than 4 doctors put together, and he did it all with OPT, other people's time. And so I learned a lot. I learned a lot about multifamily. He sold it in 2008. That's when I bought my first apartment, is 2008, which is interesting because I ended up losing it in 2011 because of the crash and the aftermath that happened after the crash. But that first property that I bought, I was making money. I was up, but when I called the lender and said I'm not going to be able to make my next payment, they were willing to take. There was some equity in it, so they took the property back. I was making about $300 a month on it until I couldn't pay for it anymore. And that's kind of like the beginning of my investing history. And then 2015, I was doing fix and flips, and I was doing tax deeds, and some of our tax deeds went well. In 2015 and 16, we doubled our money a few times in as little as 8 days. And that was really, really cool. I didn't have a lot of money myself in 2015 and 16. So what ended up happening is somebody at a tax deed seminar, they just kind of said, hey, it looks like you're young and you kind of have a feel for how real estate's supposed to go. Could I just be the money person and you do all of the work? And that worked out for us extremely well for a few years. We ended up joining that program, spent about 40 grand on it. And we did a few flips, and he ended up making his money back, and I made some money. And we built a portfolio of 23 rentals, and over just 2 years. And then we decided we wanted to get into syndication. And so that just brings me to joining a different program. Actually, I think he's on the call a friend of mine is on the call right now. Was part of the same group, and we've actually done a deal together. So we ended up joining this program, spent another 40 grand. But we were able to, close on our first deal in about 9 months, our first syndication in about 9 months. We've closed on the active side 4 syndications, and I've been passive on 3 other syndications. So when you add it all up, I've been involved now in 1,400 doors. It's about 100 million. We're managing 4 of those, and I'm passive in 3 of them. So that's where I am today. When I was in that program, the piece that I felt like was missing, and I feel like it's missing in every program, the piece that I felt like was missing is that nobody taught you really how to raise money. They told you how to legally raise money, but they didn't teach you like what made it so that passive investors chased you down. Instead, what they told you was basically how to chase passive investors down, and that always felt uncomfortable for me. It always felt awkward trying to convince somebody to put their money into my deal. And so I remember in 2016 is when I decided to start a meetup group, and in 2017 a podcast. And so all of the money that we raise is from people who find me at the meetup group or on my podcast, and they just ask if they can invest in our deals. And that's so much easier for me than trying to be a good salesperson or trying to like convince somebody to get in on a deal. So it's been a lot of fun. Our most challenging deal was a deal kind of in the middle of nowhere, Texas, like where nobody really wanted to be a part of that market. They would rather be a part of DFW or Houston or somewhere where there was a good amount of population. So just like a learning lesson for the people on the call that I learned is that we probably ought to be chasing larger markets with 1 million or so people in the MSA. That's beneficial both for how you can raise money and how, when you end up selling the property, I feel like you're going to get more buyers in a larger market. So, I probably don't want anyone to try to chase small markets with, I don't remember the population of that market, but I doubt it's more than 30,000 people. Like, you know,
Yeah.
and to me, that's not really sustainable. So for everyone on, I would say go after big markets, both because you can raise capital easier and because you can sell the
Now,
deal
where would
easier.
you draw the line in the sand as far as you know, population size?
For us, it's a million.
Okay.
I know Neil Bawa draws his line in the sand at 250,000.
Okay.
As long as it's close to a hub, as long as it's fairly close to
Yep.
a bigger city. Us, we're just trying to be ultra conservative, and I think it just is so much easier if you have a million plus. So.
Yeah, everybody has their line in the sand somewhere. I think Michael Blanc's is 500,000 is what he puts out there. But you know, I mean, the point is for a lot of people is that the bigger the market, you know, the easier it is to raise money. Number one, because people are going to be more familiar with it. There's more stability. There's more renters who can come in and occupy the place, and there's more vendors. There's more property managers. There's more of everything. So I think there's a lot of there. Now, you mentioned that metro size has something to do with ease of raising money. What about property size? Do you have any thoughts on that? Is there advantages going big or small as far as ease of raising money?
I can say for 100% certainty that if you're raising money from people who eventually want to be active, they're going to invest in your deal if it's larger. So if like for me, one of the deals that I invested in was 400 doors. It's one of Joe Fairless's deals, and it's like 400 and something doors. And when it got shown to me, I said to myself, man, if I can put the minimum into a deal like this, that's going to allow me, that's going to allow me to just at least say I'm passive in those 400 doors. And so it just helps with the way that the credibility sounds to other passive investors. When you can say that, even though I've only been involved in three passive deals, because one of them's just huge, it makes it sound more impressive when I say how many doors I've passively invested in, which I think helps other passive investors be like, oh, he's like me. He's been doing this for a while.
Yeah.
So if you're trying to raise from somebody who is eventually wanting to be active, there's so many people that are probably even on this call that if you bring them a 20 unit deal to be a passive investor, they're not going to feel like inclined to invest in that. But when you're raising money from the people that you really ought to be searching for, which is going to be people that are high net worth, they're very busy professionals, they've been playing the stock market for some time, and they're not really super familiar with apartment investing yet, but they come across you and your content and they feel like they could start getting involved in apartments. It's going to be totally easy to raise for a 20 unit deal. So it just depends on who you're working with. Some of the people that are like in groups like Brad Sumrock, Dave Lindahl, etc., Mark and Tamil Kenny, Joe Fairless, some of the people that even are there trying to learn how to be passive, even Lifestyles Unlimited with Dell Walmsley, a lot of them learn that that the larger deals, like if it's 100 units or more, it's more of a sustainable property. So if they're in somebody's coaching program, even if they just want to be passive, they've probably been brainwashed. And I don't mean that in a bad way. Brainwashing is the real term for it. They've been continuously, repetitively told that this is the safe way, this is the right way, and they believe it. So if they're in one of those coaching programs, they're probably going to be easier to raise from if your deal's larger. But again, if you're going for the right people, like if you're getting in front of people that have never done this, they're not in a coaching program, they're really familiar with stocks, you're going to have an easy enough time getting them into a 20 unit.
Okay. All right. Yeah. Good points. Good points. So I've heard a lot of people say, you know, who've done several different size deals, that once you crack the triple digits, and I imagine part of its experience as well. Once you crack the triple digit numbers, it's a lot easier to get people. In fact, we met a year ago at Dealmaker. I remember one guy at Dealmaker Live who was a passive investor. You know, we followed up with him several times, and we had a 55 unit deal at the time, and he specifically said he wanted to go with a 200 unit deal, and he admitted it had nothing to do with the returns. He just wanted to be able to brag about his door count, you know. But there's people like that out there too. So
yeah, for sure.
Very good. So let's look at this. Let's say you're brand new to the syndication world. You know, you're looking for a deal. You know, you're hot on the track, but you need to also look at raising money. What would you suggest as far as the steps to go through to get there?
Perfect. Some really good steps. So let's just say you're brand new, you're watching this, you haven't closed on your first deal. You definitely want to. The first step is going to be for you to learn your strategy, learn and decide on exactly what your path is going to be. If you're going to do multifamily only, for instance, and if they're going to be only 50 to 70 units, or 100 to 200 units, or only things above 200, or only things below 30, you figure that out, and then you decide if it's going to be A class or B class or C class or D class. And by the way, don't go for D class, but A or B or C. And then you want to figure out, you know, how much money you want to put toward each door. So basically that means, do I want to buy it for 40K per door? And am I comfortable putting 7K per door, or 3K per door, or 25K per door in work, in capital expenditures, in rehab? And so you'll try to decide all of these things, and then once you figure that out, the next step is going to be you determining what market you're going to be in. So you go and select a market, and let's just say that one thing that I think people have an issue with is they're like, well, I'm not going to find enough deals. It's FOMO, fear of missing out. I'm not going to find enough deals if I only pick one market. But you're going to be shitty at actually implementing good business plan if you're completely clueless about different markets. And that's like with us, our first couple of deals, they were in totally different cities. Like I have got deals over here, totally different states. And that's a challenge, and it makes it really difficult to be able to manage. And so what I want to try to convince the viewer to do is to select just one market, and to stop being concerned about fear of missing out. Stop being concerned about if you're going to close enough deals, and actually understand a market. Because the deeper you dive into a market, and with the brokers in that market, and with understanding the business plans available, the better you're going to be at doing your job. So I don't want anyone to just be like, oh, we're looking in the Midwest, or we're looking in the South, or we're looking at the East. I mean, pick Jacksonville, Florida, or Tampa, Florida, or Miami, Florida, or Palm Beach, Florida, or, you know what I mean? Like, select a market, and because you understand it, and because it has some of those tools. So that's the next step, is selecting a market. Once you've done that, I believe it's time for you to select a team. I believe it's time for you to start building your team. So that means that you're calling attorneys, you're calling real estate brokers, you're flying out to real estate brokers, you're buying lunch or dinner for real estate brokers, you are deciding who you could partner with. And on the first deal or two, I want you to do what we did on our first syndication. We just bought it ourselves. We didn't use a sponsor or co-sponsor. We literally just bought it. It was small enough that we could qualify for everything. We could qualify for the experience, the net worth, the liquidity. It was really easy. It was a small enough deal. But even though that happened, it was a bigger challenge that we did that alone, because since we did it alone, we didn't have somebody who had been there before. And so there was a few things that we missed. We didn't know what prepaid insurance was. We had no idea that we were going to all of a sudden have to stroke a check for 15 months of insurance, a whole year of just insurance costs. We also had no idea that because we started a brand new LLC, that the utility company wasn't going to trust us. The utility company was going to see Blue Spruce 123 Main Street LLC, which just got founded a minute ago. And now they're going to be like, oh, you know what? Since we don't know you guys in this city, all of a sudden you're going to have to do a utility deposit. And it was a big utility deposit. And there was a lot of other things that we didn't know. And if we would have partnered with somebody who had been there before, we would have solved that. We would have protected our past investors even more. We would have protected our own pocketbook even more. And so that's why I say it's so important that the next step is to build your team and to make sure that there's a couple people on the team that have done it before. So the big thing that you got to take away from that is don't have the blind leading the blind. Even if you can qualify for the loan like we could, it wasn't appropriate for somebody who had never syndicated before to not even have a co-partner, a co-sponsor on the first and or second deal. So that's what I suggest to other people is that you have your partners. And then the next thing that I would say is you make sure that you're educated. Once you have your right partners, make sure that you have the right education. So if your partners have all of the education and you don't need to pay for education, I think that's okay. But if you don't have enough education, you've got to find a way to really truly understand the business before you start buying deals. And then I would say the next step, even though I get a lot of pushback from this, from a lot of people, I'm really adamant about this being the step that happens before you start asking brokers to send you deals. You actually need to start raising money first. So once you have everything in place, I want you to build your platform, to start your meetups, to start having conversations with people, inviting potential past investors to lunch with you or to dinner with you. And I want you to start getting those relationships where you're starting to increase the amount of money that's interested in your deals, because so many other people say, if you find a good deal, the money automatically follows. And so many people try to say that they have a good deal, but that all of a sudden no money's coming. I even have had people come, I help people grow their influence. And so I've had people come to me that hear, that I help people raise more money or grow their influence so that they can more easily raise money. They'll come up and it'll be like 8 days before closing. And they'll say, we've closed on all of these deals. We have this amazing track record. And our past investors that already work with us love what we've done. But we are $2 million short and we need to close in 8 days. Can you help me? And it's like, no, when is the best time to plant an apple tree? Do you want to eat the fruit of the tree? You've got to plant it 30 years ago. You've got to already have this in place, ready to go. And it's like in 8 days, how I'm not trying to teach you how to be the best suave salesperson or to convince people that the Eskimos that they need to buy your ice. I want to find a way to have them chasing me so that when I have a deal, it's just like, I just need to let them know, hey, we've got this deal and they can be a part of it. So that's what I suggest is before you start asking for brokers to act, yes, you will start understanding who the brokers are, who the property management companies are. But before you actually start asking for the deals, I want you to have some passive investor money committed to your deal. Because when you say to the broker, I've got my property management in place and I've got all the money in place, now I just need the deal, they're going to be like, okay, this person's got their stuff together and I will start sending them deals. Because brokers are brilliant and they're some of the best salespeople in the world. And for commercial brokers, some of them are making $1 million or $2 million in commissions every year because the properties are so big. And so some of them are doing really, really well. And when you're making that kind of money, you learn how to sniff out the people who are serious versus like the people that are just brand new. And they don't want to send you something if you can't close. They need to be able to make sure that these deals close. So Have the money ready to go, have the property management company ready to go.
I agree wholeheartedly with that one. I mean, I don't think I did enough pre-raising before I got my first deal under contract. And I mean, that was a headache. It was a real headache. We ended up raising $2 million for it, and fortunately, $2 million raise, we weren't $2 million short 8 days prior, but, I wholeheartedly agree with that, but, had we put a little more effort into making those connections prior to, that first deal would have gone a whole lot smoother, but we did get across the finish line. So, all right. So you told us, number one, start getting your strategy. Number two, you pick your market. Number three, get your team. 4, get educated. And next, pre-raise money. So that's where we're at.
And then number 6 is to get your property management company set up. And number 7 is to start making calls to brokers and asking them for the deal.
Yeah. I agree with that a lot. I often, when you talk about that first call with the broker, I often liken it to a realist, just a single family realtor. When you call a single family realtor, they're nice on the phone, but I guarantee you, and try it, just cold call any single family realtor and ask them, say, hey, I'm interested in buying a home. There's 2 questions they're going to ask you every time. Have you been pre-approved? And where's your down payment coming from? They're going to ask you those. They're pre-vetting you. And you said the exact same thing with the brokers. They don't want to waste their time. They don't want to waste, they're paid on commissions. And they're going to narrow it down to the few people that they're going to make a lot of money with instead of trying to spend a little bit of time with everybody. So I agree wholeheartedly. And, had I done your direction, I think I wouldn't have spent as much time with wasting my time with brokers, because I tried doing 3 things at once. I tried raising money while I was looking for deals, while I was building my team. It worked, but it took a long time, and there were a lot of headaches along the way. But good. I like the method. You're not going to get any pushback from me on that one. That's I think it's solid. Now, as far as the specifics to the reaching out to your friends, your neighbors, building that network of passive investors, what are some specific things you recommend that people do?
Perfect. Well, I always call this the 3 pillars, or the 3-legged stool. In my opinion, is if you're doing all 3 of them, that's how you're really going to win the game. Is if you're calling, I feel like we shouldn't be calling potential passive investors. I feel like it comes across too salesy. I feel like it comes across too needy. I feel like it comes across almost like uncomfortable. So like a lot of times when we're calling our mom or our uncle and we're like, hey, I've got a great deal, do you want to be an investor? They want to be kind, they want to say yes, but sometimes they can't say yes, sometimes they can't say no. And I just feel like it's an awkward, more uncomfortable thing. So what I usually suggest is that, like with my meetup group, I created a platform where people could come and learn and grow together, and I let everybody have an opportunity to introduce themselves. And I had a very short pitch. I told everybody that was in there. We built this meetup, so it got pretty big. And I told everybody, hey, you got 30 seconds to intro yourself, because I feel like it's important to do that. But then I take about 10, 15 seconds to intro myself. And I run the meetup, and I basically say, I'll start just to show you how it's done. You have about 30 seconds to say something like this. Hey, everybody, my name is Adam Adams. I'm an apartment investor. I do syndications of deals, which basically just means that I close deals with my friends. If you'd like to be a friend and close on apartment communities and make passive income, reach out to me. And then that was it. It was about 15 seconds, and it go to the next person. But because I was able to say that each time, and first, people it stuck to people's memory. And I never like went to somebody and said, hey, can you invest in my deal? All I did was let them know that I do this. And so that seems to be very, very helpful. So in order to build that platform, the three things that I really suggest, that if you do all three, you're going to win the game. And if you look at all the big names, the ones that you can think of, the ones that have definitely been able to raise as much money as they want, I know they do these three things. And that is that they have some sort of social media presence. Two is that they have some type of live events. And three is that they have a thought leadership platform, which basically means a podcast or a coaching program or a book that they wrote, or even an ebook that they wrote, or a summit that they host. That's kind of a thought leadership. It's where people can start talking about you and saying, oh, have you read Brian Briscoe's book? Or have you read Adam Adams' book? Or have you listened to Brian's podcast or Adam's podcast? It's people being able to start talking about you and people getting to know you. That's what I call a thought leadership platform. Something that's sitting there, and once you put it out, it stays there. Then when we talk about live events, it doesn't necessarily need to be a conference. It doesn't have to be a big thing. What you're doing right now, Brian, this is a live event, right? This is something where at the end of the first hour, where we're kind of doing education, the second hour is all about people just getting to know each other. And that's an opportunity for people to kind of come together and feel like they were heard and feel like they're adding value and know that they can start doing deals faster because you give them that opportunity to do that. But at the same time, they see you as the leader, which is kind of interesting. There's a lot of good, I saw a lot of the names pop up even in the first few minutes before we started recording. And I was like, man, there's some hitters on here. There's some good people. There's some people that have big influence on LinkedIn on here. There's some people with big influence on social media. There's some podcasters on this call. But what's interesting is most of the people, let's just say you have 30 people on, most of those people, if they determine that they want to do business with somebody, they're not going to do it with Adam, the speaker, as like that. I'm not going to be their first option. They're not going to do it with some of the other people that are in the group as their first option. They're going to go to the person who runs it. They're going to come to you first for advice. You know what I mean? So for other people, I feel like they need to be having these live events, whether they're virtual like today, or a dinner that they're hosting, or a conference, or a workshop, or a boot camp. They've got to have some type of live event. And so we talked about thought leadership, like a podcast. We talked about live events, like a meetup. The third one is what they do on social media. And if I didn't have my social media presence, like my podcast never would have blown up. And my podcast that I just sold, congratulations. I can't believe that it's all sold. And I can start my new podcast. But that one literally made it higher than the top 1% of all podcasts on iTunes. So out of 700 and something thousand podcasts, we're one of the top, hundreds. And what makes 700,000? Yeah. So what makes me excited about that is to understand that it wasn't the podcast that made the podcast popular. Remember this. If you're on here, just think to yourself, even make this a rhyme. It's not the podcast that makes the podcast famous. It's what you do on social media. My meetup group, I ended up speaking at meetup headquarters in 2018, in April of 18, because my meetup was one of the top 6 meetups out of 225,000 meetups across the world. They have meetups in a lot of countries. I don't know if anybody knew that, but they flew out a bunch of us. And it was not simply because I just posted it on Meetup. And that's how people automatically came and got involved and started thinking that this was like a great meetup. It was what I did on social media. What I do on Facebook is why my podcast blew up. It's why my meetup blew up, because I'm always telling people what I'm doing. And so because people know about it, they can go. And so if you do those three things, if you have a strong social media presence, some type of live events, even if it's just a one-on-one dinner, and you have a thought leadership, a book or a podcast or whatever, that's how you can attract the most amount of capital. That's what's made it so we've been able to close on all of the deals that we put under contract. We've been able to raise all of the money. So there was a challenge one in the middle of Texas, in nowhere Texas, but event with the partners, we were able to get all of the money for that one raised. But the rest of them have been fairly easy, just because they're in a little bit stronger markets, and we just be able to have 2 or 3 webinars, and it's full.
Yeah. I love those. I mean, I'll tell you what, I cannot log on to Facebook and look at my notifications without seeing Adam Adams in there somewhere. And that's something that's just being omnipresent in a lot of ways drives a lot of people to that. I like how you link that. Your social media is linked to your live events, and that's linked to your thought leadership platform. The 3 are going in tandem. It's not 3 separate efforts. It is one effort using 3 different medias. Is how I take that.
Yeah.
So, but 100% agree. I love how you just distilled that into 3 easy things. And, it doesn't have to be everybody do a podcast, everybody do a, but thought leadership program platform, you have to have something out there that kind of establishes yourself as an expert. You have to have some events. And I hope everybody took notes, the host, go to the host of the meetups, if you're looking to invest capital. And then, social media presence. Now, just one thought. Why did you choose Facebook over, say, LinkedIn or another platform?
Yeah, I just like Facebook. I am a fairly personal type of person. I like posting about, mountain biking. I like posting about my kids. I like posting about date night. I enjoy that. I want to do that. And I suggest anybody, when we talk about the thought leadership or the social media or the live events, just pick one of each. Okay, you're not trying to have all of the types of live events all at the same time. You're not trying to be on, when we say omnipresent, I'm not trying to be on LinkedIn at all, or Twitter. I don't even have a Twitter account. I barely even touch Instagram. I make a post there like once a month maybe. So you just got to pick the one that kind of works for you. And so for some people, that's the new TikTok platform. And for other people, it's LinkedIn, because it's a business platform. And the average person on LinkedIn makes 6 figures. For me, it wasn't about all of that. It was just about who I am as a person. So just think about you and who you are and how you are and which one works for you, and just focus on one. I know a lot of people that raise a ton of equity and they focus on LinkedIn. It's literally just pick one and stay with it. Get in your lane and just go one way. Don't try to do it all. Don't try to be everywhere. You're just going to stress yourself out, and you're going to find that one of them fits your personality best. One of them is going to fit your personality best. For me, that's just Facebook.
Okay. All right. Now, I know you used to, last year, I think October time frame, you had a Raising Capital Summit. Are we going to see another one of those come up anytime soon?
Yes, we've got the Raising Money Summit. It's a 4-day event. One day teaching how to just brand yourself. One day teaching how to get investors to opt into your list. That's kind of like, once you do the 3 pillars, the next step is a lead magnet. And how after you're already adding value, how to get people on your list. So on the second day, that's all we talk about, is how do you get people to actually come onto your list, where they're saying, can I please invest with you, Brian? And they're getting your lead magnet. We don't call it a lead magnet when you give it to them. You just call it a piece of value or a checklist that they can download for free. But it gets them onto your past investor list. The third day, we talk all about just how to manage your list, what software you need, what just every detail about how to manage the list. Like, because if you're trying to raise millions of dollars, you probably are going to have hundreds of people on your past investor list. It's going to be difficult to do that with the knowledge you have now. So we teach everything you need to know how to manage it. And on the last day, it's focused on how do you call the capital. So we talk a little bit of some psychology, how to really persuade, how to really come from a position of strength, and how to influence somebody to want to jump into this deal sooner if they're ready. Like not how to manipulate anybody, but just if they want to do this, how to get them to, poop or get off the pot, basically. Like if you want to do it, do it. And so we share a lot of how to run the webinars, how to call the capital, how to follow up on the last day. It's just basically how to get people to actually invest in the deal. So it's going to be October 1st through 4th.
October 1st through 4th. Now, is it going to be virtual this year, or are you going to do a physical event?
We were doing our best to do a physical, live, in-person event, and as of Friday, we've found that it's just going to be too much of a challenge with COVID this year, and so we're gonna do a virtual event. But I like that you asked that, because one of the reasons why people go to live events is because of the networking.
Right.
And so we have found a platform that literally is, it looks like you're at a conference, and you can just join a table and sit down with just a couple of people and network. And we're putting a lot of time and attention into making sure that people have the opportunity to network and connect with other people. So I'm really excited. It's going to feel like a in-person event, but it will be online.
That's amazing. I mean, we just did Dealmaker Live with Michael Blanc last weekend, and compared to the other ones that were physical, I mean, there was a lot of good content. Don't get me wrong, but when you're not rubbing shoulders with people, breaking bread with people, it's just not quite the same. So good. Now I will say, and this is plug for your event. Several people I know that went to last year's event said that it was hands down the best one they've ever been to, as far as just breaking things down, actionable items. And I mean, they left that event with a lot of enthusiasm. And I know a lot of them ended up doing amazing jobs raising capital afterwards. So, kudos. I think it's going to be a great event again. So mark your calendars. October. Give me those dates again.
Thursday the 1st through Sunday the 4th.
1st through the 4th. Okay, good enough. All right. And I can't wait till we can get back together again and do all those things. Drink whatever your preferred beverage is with some guy next to you, and but until then, I guess Zoom and whatever that app is you're talking about are going to be the way to go. So, well, good enough. Yeah. Good enough. Now, I also understand you have a platform building course as well. Can you tell us a little bit about that?
Yeah, it's our mastermind group, and okay. There's a fee at the front, and then it's a couple $100 a month. Okay. And what it is, it's like a group coaching program, and the only thing, it's like a lot of people are like, they're a member of Michael Blanc's, or they're a member of Brad Sumrock's, or they're a member of like all of these different groups, but they join ours as a supplement just for growing their influence, because it's not taught as much in some other programs. So we get really granular, kind of like what we've talked about today. And so it's a platform where it's a small group of people, and all we talk about is how do you make your meetup thrive? How do you call for the capital? How do you, if you're going to start a podcast, how do you get into the top 1% so that people are actually listening? Because it's a waste of time to start one. If you're going to be in the 99 percentile, you're just kind of lost in the noise. And so we teach how to hack Facebook algorithms, but it's all around growing your influence and raising capital by people chasing you. So it's just called Raising Money Boardroom. It's small group, and it's nowhere near a $40,000 course like the two that I paid. It's just a good supplement if you're if you're already raising capital and you want to be, you don't want to have to hit a ceiling, or if you're new to the game but taking someone else's course in the space, I really believe wholeheartedly that it's the best option out there to be able to grow, because no one else is really teaching Facebook the way we teach Facebook, or podcasting the way we teach podcasting, or meetups. So just to brag real fast, I've been very helpful to some of the other influencers to fill their seats. And so I've been the #1 affiliate for 3 of the big influencers for the last 3 years, because being able to market and get people in the seats is generally hard for other people. And so I've been able to partner with some other influencers to make sure that their live events had, 600 people. And that's what we teach in that group, is so you'll be able to do what, the influencers are doing. So.
Okay. Nice. I appreciate that. And once again, I've heard some really good things about the mastermind as well. And I mean, you're right. A lot of people, I went through the Michael Blanc program, and, no knocking it. He teaches a lot of good things. But he does focus a lot on the analysis, which, depending on, I think everybody has their own focal point when they build their coaching program or whatnot. But a lot of the guys I know who are in your program, once again, were in the Michael Blanc program as well. I think you hit the nail on the head. A lot of people are using yours as a supplement. You go through the Michael Blanc program, he's going to put a lot of focus on the syndicated deal analyzer, how to analyze deals. And that's his main meat and potatoes. But yeah, I agree wholeheartedly. All right, let's see if we have some questions from the crowd. We got the chat on here. If anybody's got any questions, drop them in. I got one from Jerome Myers saying, "How do you sell a podcast?" I mean,
awesome. Well, on that, I went to just cancel the podcast, Jerome. I was just thinking, creative real estate podcast doesn't attract my perfect avatar. In no way does having the creative real estate podcast have anybody join the podcast just from looking at it. Yes, there are some referrals, but no passive investors are automatically going to be like, oh, perfect, I have no money, so this is what I need to go. If they have a ton of money, they're not going to be on the creative real estate podcast. So I remember thinking that I boxed myself in. So I was like, how do I just stop this and do another one? What should I do? And so I talked about it in a mastermind of mine, and someone just came up and said, why don't you try to sell it? And so I thought to myself, I guess it is valuable. There's a lot of listeners, and it is. And so all I did is I reached out to a couple of people, and I just said, hey, if I do this, this, and this, would you buy the podcast from me? And what ended up happening is the first person I talked to took the offer that I said. And then I went to my mastermind. I went back to my mastermind and said, you guys are brilliant. I sold it for the price that I wanted. And I told him the price that I wanted. And like 3 people said, I would have given you 50 or 60 grand for it. And I was like, okay, well, that's a little less than I ended up selling it for, but I'm already under contract. So it wasn't too hard. Here's the major things that I had to do, Jerome. I had to be part of the podcast for several months after the sale of it, so that it was a smooth transition. So that it wasn't just Adam Adams, and all of a sudden Jason Lewis, and people are like, oh, this changed, and I'm not interested in it anymore. So we did a lot of interviews where it was him and me at the same time. We did a few interviews where it was just me, and we were spreading those out. We did some interviews where it was just him. And when he comes on and introduces himself, he says he's the co-host, even though he actually owns it now. He's like, this is Jason J. Lou Lewis, co-host of the Creative Real Estate Podcast. Anyway, so it was a transition thing. And I think that was part of the helpful reason why I think it's going to continue to have a good listenership, even after it doesn't have my face on it anymore. But I can go into more detail on it. But those are the major points, is I just told somebody, what they would get out of owning it. how many listeners they would have. And then I told them that I would help the transition.
Yeah. I mean, people are subscribed. I mean, whether you own it or not, it's still on my subscription list. And when there's a new episode, it still comes up to the top, and it's just like, oh, hey, look, there you go. Tap and listen. So, all right. Yeah. So, let's see, 2 more questions, and then, we'll try to get you out to date night here. Question number 1 from Dustin says, how can a new investor who is still working on getting educated create value for investors or partners?
Awesome question. Well, if you are like Adam Adams or Whitney Sewell or Joe Fairless, who founded a podcast before they syndicated a deal. I started my podcast when I knew I wanted to syndicate deals, but I had not yet closed one. And same thing, Joe Fairless, I think he had 2 or 3 houses when he founded it. And same thing with Whitney Sewell. One of the best ways that you can add value to partners and to passive investors is by having a platform where you educate. And most people are concerned. They're like, well, like Whitney Sewell, for instance, he's like, hey man, I haven't closed a syndication. Why would I have a podcast called The Syndication Show? So you just got to be comfortable with knowing that you're just going to add value to other people in that space. You're going to learn from other people in that space as you're interviewing on podcasts, and you're going to be able to influence passive investors to get in on deals. So that's a huge way to be able to become value to other people. So once you have a platform, you can add value to passive investors by maybe partnering with somebody who's been doing this for a long, long time. And you can partner with somebody who's been doing it for a long, long time because you have a platform where you can pull passive investors. So essentially you become the connector. And that's a huge way for you to be able to add value, is just understanding. And one thing that I would say is, if you're willing to do a podcast, like I'm trying to say you should, if you're willing to do that, one of the things you can do secretively, but tactfully, is you basically just ask the person that you're interviewing what they're struggling with in their business. Everybody listening wants to know that anyway. But if you become an active listener and you say, like, what are you looking for in your business? What was your last challenge? What is there any struggles that you're going through today? And you hear what the active person says, then you might be able to say, I know how I could solve that problem. After this recording, after we get done doing the recording, maybe I could just ask Michael Blanc if since he's never told me that he's having a challenge with deals, but just pretend like you're interviewing Michael Blanc and he says, the big struggle right now is finding deals. And now you say, well, if I could just get you a deal, Michael, would you be able to raise the money? Would you be able to sponsor the loan? Would you be able to manage the deal? Because I haven't done one yet. Michael's, or whoever it is probably going to be like, yeah, if you find me a good deal, I'll bring all of that, because that's their missing piece. So I would say that's how you can add value if you haven't done a lot, is to get your thought leadership platform and become the connector.
Yeah. All right. I like that. All right. One more question. What kind of cash on cash returns do you target? So when you're underwriting deals, I guess what's your line in the sand for cash on cash return that you want to give to investors?
Yeah. Well, in my coaching program that I learned from, we were taught that it needed a cash on cash return 12% total for the whole deal in the first year, so that you could give about 6 to 8% to your past investors right away. And I think that there's a lot of wisdom to that. To be honest, I think that, the Holy Trinity that I learned in the beginning, I think there's a lot of wisdom to that. But we don't do that. We have found that if we can get into a deal, even if year one is a rough year or tough year, and it doesn't have that 12% cash on cash, for the whole group. So you can give your passive investors like 8-ish%. Even if you see that at the end of the deal that you'll be able to have IRRs of 14, 15, 16%, which basically is a cash on cash return total of around 18, 19%, maybe 20, 21% to the passive investor after 5 to 6 years. We feel like that's a screaming deal, even if the first year or two is a little rough, as long as you have a good team. So when we look for cash on cash, we want to look at the whole 5, 6 year, the whole hold period. And we want to try to understand what are our projections conservatively at the end of it. And if we find that we can give our passive investors something that's beneficial to them, like 14, 15, 16, 17, 18, 19% after 4, 5, 6 years, we feel like that's a win. We feel like that's an absolute win. And then we usually own like 30% of the deal. So whatever the remainder is, our team will usually get that.
Okay, nice. Well, we're right on the 1 hour mark on the dot. So just like to thank you very much for taking time out of date night, and thank your beautiful partner for allowing you to spend an hour with us instead of with her tonight. Very much appreciate that. Took a lot of notes, and I like how you had everything. Just it's like you've given speeches like this before, because it was just A to Z already done. But I took a lot of good notes, and there's things here that I'm going to immediately implement. So appreciate your time. And how can people get a hold of you and get involved with some of the things that you're doing?
Awesome. Well, if they want to go on Facebook, all I recommend is that they at least send me a private message on Facebook too. So you can friend me on Facebook. But if I don't know you, I probably will ignore it. But if you give me a PM that says, I saw you on Brian's webinar or podcast, I saw you on Brian's show, would love to connect, that's going to be the easiest way. And if they are looking to come to the Raising Money Summit, they can go to raisingmoneysummit.com. Very easy. And if they're looking for any coaching or consulting, they can go to raisingmoneycoach.com.
Perfect. Well, thanks for your time.